Okay, let's get into this. We're diving deep into the source material on Benjamin Graham's The Intelligent Investor.
Right, the classic, the book that really, taught Warren Buffett his framework.
Exactly. And our mission today is, well, to pull out those core principles, the rules that separate real investing from just gambling.
And see why they're still so relevant even in today's crazy markets.
Yeah.
The source material we looked at, it opens with a very specific phrase. Welcome to our channel, the Audible Review.
Right, I noticed that. It kind of sets a tone, doesn't it?
It does. It signals right away, I think, that this isn't going to be about hot stock picks or get-rich-quick schemes.
No, it's about discipline, patience, a long-term mindset.
Exactly. The central idea really is that mastering your emotions, that's way more critical than trying to predict what the market's going to do next week. Focus on value, not hype.
Okay, so let's start with Graham's first big distinction. He forces you to decide right away. Are you an investor or a speculator?
Yeah, that's lesson one. And it's fundamental. An investor, for Graham, buys ownership in actual businesses.
Right, you own a piece of something real, and you have the patience to let it grow.
Whereas the speculator, well, they're treating the stock market more like a casino, aren't they?
Yeah, buying and selling based on tips or feelings or just market buzz.
And Graham actually breaks down investors further, which is interesting. He talks about the defensive investor and the enterprising investor.
Okay, what's the difference there?
Well, the defensive investor wants safety above all else, minimal effort. Think index funds or very stable blue chips.
Got it. Low maintenance.
Right. The enterprising investor, though, is willing to put in the work. Deeper analysis, looking for undervalued opportunities, maybe aiming for higher returns.
But crucially, both are buying based on the business fundamentals.
Precisely. They're both owners. Which leads us nicely into maybe his most famous idea, the margin of safety.
Yes, lesson 2. Everyone talks about this one. The core idea is always leaving room for error, right? Never pay full price.
Exactly. The analogy used in the source is great. Buying $1 for 70 cents or, a $100 bill for $70.
That gives you a buffer, a cushion.
It does, but it's not just pulling a discount out of thin air. Graham defines it. For that defensive investor, for example,
Yeah.
he needs specific things. Adequate company size, a solid history of positive earnings, like 7 straight years, and a sensible debt level.
So you're demanding measurable proof of safety, not just hoping the price is low.
You're building that cushion based on facts, not just feelings. Which brings us to the next point. Because even with a margin of safety, what happens when panic hits?
Right. Your analysis might be perfect, but if the market tanks and fear takes over, you can still end up selling at the bottom.
And that's why Graham hammers home lesson 3. Temperament matters more than IQ, your emotional control.
So being smart isn't enough. You need to be, well, rational, disciplined.
You absolutely do. Graham warns that your own fear or greed can destroy your returns faster than any bear market. You have to protect yourself.
Okay, this makes sense. Which leads perfectly into the Mr. Market analogy, right? Lesson 5. This feels like the ultimate test of that emotional control.
It really is. Mr. Market is Graham's brilliant personification of the stock market itself. Imagine him as your business partner.
Okay.
But he's completely manic depressive. Some days he shows up euphoric, offering to buy your share of the business for a crazy high price.
Uh-huh.
Other days he's deeply depressed, desperate to sell you his share for way less than it's worth. He's pure emotion.
So your job isn't to get swept up in his moods.
No. Your job is to ignore his emotional swings most of the time, but be ready to take advantage of them when they become extreme.
Use his pessimism to buy low, or his optimism maybe to sell high if the price gets ridiculous.
Exactly. The market is there to serve you, provide opportunities. It shouldn't be your master, dictating how you feel or act.
And that naturally forces a long-term perspective, doesn't it? Lesson 4.
It has to. If you stop reacting to the daily noise, the quarterly reports, Mr. Market's moods, you automatically start thinking in terms of years, even decades.
You focus on businesses that will be solid 10, 20, 30 years down the line.
Wealth isn't built overnight. It's built over time by owning good companies bought with that margin of safety.
So boiling it all down, the intelligence in the intelligent investor isn't about being the smartest analyst or having a crystal ball.
Not at all. It's about having the discipline, the emotional control to stick to these sound logical principles through thick and thin.
Period. And, it's interesting. Even the source material we used reinforces this idea of ongoing effort. It wraps up with that call to action.
The do like, share, and subscribe to my channel for more videos part.
Yeah. Which, in this context, kind of underlines that applying Graham's wisdom isn't something you just learn once.
No, it requires continuous commitment, constant learning, deliberate focus, sticking to the plan. The principles are simple, but actually doing it consistently, that's the hard part.
Absolutely. So thinking about that, if the market is supposed to be your servant, not your master, what's one concrete thing you, the listener, can do this week to actually practice that, to stop listening to Mr. Market's noise and focus on your own rational valuation? Maybe calculate a real margin of safety before making any move? Something to think about.